Hello everyone and welcome to a word from Trevor on Techno Fundamental Investing. My name is Nrupen and in this video we will take a look on investing methodology of most influential investor of our time, Sir Benjamin Graham. He is also known as father of value investing. Keep in mind all of Graham's books are advanced level guides and thus are extremely difficult to understand for average investor. In this video I will try my best to give you easy to understand breakdown of some of his work. But as I always say, no video is good enough to justify original work of any investor. So it's better for you to take a look on his books if you are advanced enough to understand them. First, we will try to understand his investing ideology, then method of analysis, third risk management, and finally strategy. Benjamin believed market is not predictable and it doesn't matter who you are, what are your educational qualifications, and how much success rate you have. Absolutely no one can predict market direction. So there is no point in predicting market direction. Understanding that nothing is predictable is biggest edge any investor can ever have while investing. Everyone buys when times are good and everyone sells when times are bad. This is how crowd reacts. The crowd that reacts does not make money. So to be sure we make it, we have to separate ourselves from crowd, and rather than reacting, we should respond to reaction of crowd. Basic investing psychology is high risk yields high rewards and low risk yields low rewards. Benjamin realized that if he invests in any stock, then his maximum loss would never go below 100% because the minimum price a stock can ever go is 0. On other hand, if business progresses, the potential rewards can be exponential. A business can either go out of business or it might just keep working as it is, or it can start progressing and become very huge. He realized if maximum loss is 0 and maximum profits are exponential, then loss, no matter how big it is, will always remain arithmetic. On other hand, when profits will come, they will be logarithmic. From which he came to conclusion high risk, high reward and low risk, low reward mentality is wrong on all levels. On other hand, we can also reap high rewards on low risk. This idea became cornerstone for value investing. Benjamin thought, what if he can devise a method with help of which he could actually pick only those stocks which have very high probability to not go out of business. With this thought, he introduced something to fundamental analysis that Jack DeFries introduced to technical analysis, and thus value investing was born. The thing that he introduced was risk management. Value stocks are those stocks which hold very high potential of profits and very low potential of loss. Note that Graham gave investing method for every kind of investor, but in this video we will strictly focus on Graham's value stock. He also realized that to make sure risk remains minimum, he should not be investing in current market value of stock, but in future financial value of business, and therefore concept of intrinsic value was required for his method of investing. Now reality is intrinsic value is very complex term, and depending on your investing ideology, you can provide different meaning to intrinsic value. Some might consider intrinsic value based on qualitative factors, others may consider on quantitative factors. New investors have heard intrinsic value so many times that they are kind of in dream world where they believe that if they would be able to calculate intrinsic value of business, then they would become successful. But they don't understand intrinsic value can never be a precise number but an estimate. Second, it is also relative. Third, with respect to what you want to look at intrinsic value, its definition and method of calculation varies. If you will search YouTube with how to calculate intrinsic value, you will get possible different methods of calculating it. Most popular variations are based on cash flows and earnings of business. Unless you can already understand how different businesses operate differently, intrinsic value is possibly the most useless number you should be worried about as an average investor. Benjamin's method definitely was based on his method of intrinsic value calculation. Final thing that you should know is that Benjamin Graham was first to introduce idea of automating investing process. He introduced this idea because there are hundreds of stocks in stock market and researching all of them will take like forever. So we must have method to shortlist stocks of our interest for research rather than taking a look on all of them. As per his method, he would prefer stocks in which price to book ratio should yield result less than 1.25. As we will move ahead with video, you will understand why that number is important. But for now, keep in mind, it does not mean stock whose price to book ratio is less than 1 are value stocks. As per Graham, a successful business makes a lot more than what it requires to stay in business. Now, what it tells about that business? First, since this business makes more than what is required, it cannot have huge debt. So the very first thing that we need to know is debt is low or not, for which we see debt to equity ratio. Formula for total equity is total asset minus total liabilities, whereas formula for debt to equity is total debt divided by total equity. Note that total equity means net worth of business. In front of you is balance sheet of Uflex, in which total net worth is 2041 crores, whereas total debt is 1116 crores. To get debt to equity ratio, we will divide Uflex total debt with net worth. The answer is 0.55. We can verify answer by taking a look on key financial ratios page. Our answer 0.55 tells us for every 1 rupee, Uflex is under 0.55 paise in debt. For matching Benjamin's criteria, debt to equity should be lot less than 0.55. 0.25 or less is most likely the best choice. Next, since business is consistently making more than what it requires to stay in business, its net sales should be increasing every year along with positive EPS. Note that I said increasing net sales with positive EPS, not increasing EPS. It is very less likely for you to find a business with increasing EPS and low debt to equity ratio. In front of you is yearly results for Uflex, in which you can see increasing net sales every month. Along with this, we only need positive EPS, not growing EPS. Finally, if a business makes more money than it requires to stay in business, it will always have a positive cash flow. Now, I have already created a video on reading cash flow statement, so I wouldn't be wasting time in this video too. You can either take a look on one of my older videos or just search YouTube with how to read cash flow statement and you will find more than required number of videos on it. For now, just remember, a business that makes more money than what it requires to stay in business have low debt to equity ratio, low debt, total equity and net sales grows every year along with positive EPS and positive cash flow. That's general method of analysis. Step 2 is risk management. Graham believed a business have two types of valuations. First is business valuation and second is market valuation. Business valuations are those valuations which reflect actual financial worth of business, a price for which you would be interested in buying the business of underlying stock. Business valuation and intrinsic value of business are one and the same thing. First, you have to understand a standard formula to calculate intrinsic value of stock cannot exist, looking at the fact there are lot of different things that needs to be considered before you decide to buy a business as whole. Second thing to keep in mind is that it can never be a precise number but always an estimate. There is so much hype about intrinsic value among average investors that they are in kind of dreamland that somehow if they could calculate intrinsic value, it would guarantee them successful investment. What they fail to notice is educational qualification and amount of experience required for estimating value of business based on its current state, which includes taking into note equity, leverage, life of business and ability of business to perform for its expected life. Calculations are not only arbitrary but also tricky in themselves. Keep in mind there cannot be a standard formula to calculate intrinsic value of business. Every formula is circumstance specific. Market valuation of stocks is value that market assumes should be value of business. It can be less or more than actual valuation of business. Since market valuations of stocks can be higher as well as lower as compared to actual business valuation, Graham decided to buy stock when market valuation of stock is equal to business valuation of business. Now, to make sure he is buying stock at business valuation, he needed something that can be used as price benchmark for purchase. This price benchmark was book value of business. He would buy stocks if price to book ratio would be near 1. For example, take a look on price to book ratio of Uflex. Here you can see price to book ratio is 0.85, which translates to market valuation of Uflex is less than its business valuation by 0.15. The stock is available for 15% discount or 15% bargain price. The discount or bargain is what can be called as margin of safety for Graham's investing method. The role of margin of safety is to provide protection to our investments against market fluctuations. Margin of safety only guarantees less risk. It doesn't guarantee any rewards. Benjamin's personal favorite were those stocks which could be bought for PBR of 0.66. In short, we can say that Benjamin preferred 30 to 35% discount on price. Next thing that was important to Benjamin during purchase was price to earning ratio. He mostly preferred PE less than 15, and reason for that was Benjamin's point of view on PE. Graham would consider PE as number of years in which he would be able to recover his investment from business if business continues to earn at same rate, or as number of years required for business to grow to an extent so that its earning potential matches the price paid. For example, take a look on PE of Uflex. At present, Uflex is trading at 431 with PE approximately equal to 9. Right now, EPS of Uflex is 28. The PE of 9 states if Uflex continues to grow its EPS at current rate, then addition of EPS over next 9 years will yield number greater than 431. Everything after 9 years is pure profit on investment. As we know, Graham was long-term investor and his minimum holding time was 15 years, due to which he recommended to buy stocks when PE is below 15. Unless this condition is matched, low PBR is useless. Things to learn from his risk management is PBR and PE contribute to margin of safety if stock matches investing ideology. You can scan for value stocks by looking for low PBR and PE, but for being called a true value stock, it should also match his investing ideology, else you would be just picking chunk on name of low PBR and PE. Low PBR means margin of safety in quality stock, and low PE means earnings are extremely high but price is less, which concludes to extremely low risk potential but extremely high profit potential, a condition required for being a value stock. Now, to most investors who try to invest on Graham's model, though are able to find ideological match but couldn't find a mathematical match of PBR equal to or less than 1, for which he gave strategy. Buy a business when it is getting unappreciated by market. The time when business delivers less quarterly earnings, or time when blood is running high in market. Which means if Uflex would have matched every required criteria of Graham, then January and February would have been the best time to buy Uflex because quarterly result of December 2016 were lower than December 2015 quarterly results. You have to understand that one bad quarterly result does not equate to overall bad performance. This is the time when crowd is acting irrationally, and this is the time when you should be acting rationally by starting to buy, because this is the only day you might be able to pick mathematical match to Graham's value stock. The final thing that you should know is that Graham recommended to invest in multiple stocks, not just in one stock. In fact, Graham recommended over-diversified portfolio of value stocks, and as per him, if all other factors of value remain unchanged, then you should scale up your position with each new fall. He also recommended not to depend on investing once or twice a year. On the other hand, one should invest a small amount every month in stocks you trust because it will help you average the best bargain price. Finally, we will take a look on why Graham's method works, its advantages, limitations, and how it contributed to overall investing community. But before that, I would like to share just few lines from original work of Graham for those investors who are misled by idea of value stock, maybe because of marketing or because they intentionally mistook it. Here's the first from The Intelligent Investor, Indian Subcontinent Edition, Chapter 20, Margin of Safety, page number 518. Here in his own words, Graham said, unless stock matches very low risk versus very high reward criteria, it ain't a philosophical match to his investing method. On very next page, he also mentions a growth stock, though are little riskier. If managed to have low risk with respect to high rewards, it qualifies to be a value pick. Either you pick stocks fundamentally or technically. Either you pick high PE or low PE. It doesn't matter if you pick micro cap, small cap, blue chip or industry leader. The only criteria a stock has to match for being a value pick is low risk versus high reward. Everything else is just BS you believe in. And here's definition of margin of safety on same page. We have here by definition a favorable difference in price on the one hand and indicated or appraised value on other. That difference is margin of safety. He also mentions the role of margin of safety is only protecting your investment from market fluctuations. Absolutely anything that can serve this purpose can be called as margin of safety. For Graham's investing method, it was low PBR and low PE. If your method of investing differs, you can have different margin of safety. Here is next thing that you should take a note of. There is a close logical connection between the concept of safety margin and the principle of diversification. One is correlated with the other. Even with margin in the investor's favor, an individual security may work out badly. The margin guarantees only that he has better chance for profit than for loss. Not that loss is impossible. But as the number of such commitments is increased, the more certain it does become that the aggregate, if the profits will exceed aggregate of the losses. Diversification, by accepting it so universally, investors are really demonstrating their acceptance of the margin of safety principle to which diversification is the companion. The more numbers he wages on, the better his chance of gain. Finally, to have true investment, there must be present true margin of safety. And true margin of safety is one that can be demonstrated by figures, by persuasive reasoning, difference to a body of actual experience. The reason why I showed you this is because there is a lot of bullshit I hear about value investing, and people who spread this bullshit till they read it in The Intelligent Investor. First thing to keep in mind is that even the most experienced investor will agree that Benjamin's work is probably the most advanced work on investing. It is advanced even for advanced investors. Anyone who claims he understood it in single read is most likely a moron, and you shouldn't believe anything he says. Even I have read The Intelligent Investor multiple times, and so have the investors I know so far. Celebrity investors that we see on television, even they would agree Graham's work is also tough for them. The person who tells you about low PBR and PE is condition required for value investing is the person you should be running away from. Graham's work tells us about all kinds of investments, either you want to invest for growth, security, dividends, or turnaround. The investing model that we saw in this video is most popular investing model of Graham, but not the only model he discussed in his work. Few things that you can take from this is that Graham never said my method is only method of value investing. He stated for time your investment satisfies low risk, high reward criteria, it is a value pick. Next, margin of safety does not mean low PE and low PBR stock. It can be anything that can offer your stock protection against market fluctuations. Finally, bargain price doesn't mean buy below book value. It only means that stock is available at discount with respect to future prices. Value pick, margin of safety, and bargain can differ based on your investing model, and no investing model is strong without proper diversification. Now let's try to understand why Graham's investing model works. To understand that, let's take a look on economic cycle of business. When a stock actually starts trending upwards, it means business has entered its growth economic cycle. An economic condition developed in market which can help a business increase its earning potential is known as economic trigger. Economic trigger is required for any business to enter its growth stage. Graham's method focuses on finding stocks that are earning consistently every year without fail. A business that performs consistently against all odds usually have extremely high chance to enter into growth stage because of economic trigger. As per my personal experience, majority of stocks that I have seen so far start running as soon as economic trigger makes stock enter growth stage. Usually most of the Graham's value stocks start exhibiting upside with break of long-term resistance. For example, I will show you few stocks from my portfolio. First is Agarwal Industrial Corporation. Here we can see that stock broke a multi-year long resistance to start its upside journey. Next, JBMA also broke multi-year resistance to start its upside journey. Explosive results resulted in break of multi-year resistance as an economic trigger. Also keep in mind a stock can also break up with explosive upside when its book value increases with huge margin against market value, and it is also considered as economic trigger. Here's Uflex, which also broke multi-year resistance. Note that these are not stock recommendations. These are just examples provided as techno-fundamental case study. Do not buy these stocks just because I showed them to you as example. Buy stocks based on your own research with good risk management and strategy. I personally never look for mathematical match to buy any business. I always look for ideological match and buy it on economic trigger. That's my personal method of investing. Advantages of Graham's method is that the stock that would start generating profits will not only generate huge gains, but will also become high dividend paying monsters. Disadvantages include very long waiting time. Graham knew predicting is futile. On the other hand, the best thing he could do is wait for stock to unlock value. Other disadvantage is that unless economic trigger arrives, stock will not exhibit upside, and in case stock starts underperforming before economic trigger, your waiting time may go in drain. Finally, Graham's method is designed in era when concept of intellectual assets were not as developed as today. Therefore, his method of analysis is more focused on physical assets of business along with its earning power. So if a business possesses more intellectual assets than physical assets, Graham's model will most likely fail to detect value in such business. Businesses like Microsoft would buy Graham's investing model were expensive since day one. The magnificent gains that Microsoft deliver its investors is evidence of the fact no matter how expensive Microsoft appeared with Graham's model, reality is that it delivered exponential gains to its investors for years. It cannot happen unless stock is already undervalued to begin with. To end this video, let's take a look on Graham's contribution to investing industry. First, he taught investors to not see investing as method but as process. He introduced the idea of seeing it as three-step process of analysis, risk management and strategy. He helped investors understand process of investing can be semi-automated with help of ratios and numbers. He introduced why a theoretical model of successful business as investing philosophy can help you make better investment decisions. He was first to introduce idea of systematic investing plans, investing ideology, risk management, margin of safety, systematic and over-diversified investing. There is no doubt Graham was one of the most intelligent investors of our time, if not the most intelligent one. His investing methodology and research inspired many and also became a reason why we today can do low risk, high profit investments. By all means, he deserves the title of father of value investing and there shouldn't be any doubt about it. With that said, thanks for watching this video and have a nice day.